Jason Baker, Vice President, Associate Publisher, Tampa Bay Business and Wealth. It is great to see your smiling faces once again. We took a little bit of time off with our virtual connects because we've been busy. I think as a lot of you know, we've actually started our CEO Connect series once again, live and in person. A much smaller group. It looks much different than it has in the past. I see Cindy clapping her hands, thank you. Much different than it has in the past with masks and social distancing and fun thermometers for all. But it seems like everybody's really happy to getting back to doing a little bit of person-to-person normal business as we start to see things sort of settle down in this crazy world right now. So this is our Virtual Connect series. As you all know, this one is Creative Cash Flow Strategies for Innovative Companies. And I, for one, am very excited to hear what this panel has to say about that because I've heard some of the background conversations and there's some pretty cool stuff that's here, some pretty innovative stuff. Virtual Connect series, as you know, is designed to continue offering needed content to our partners during these crazy times. And this will continue. Even when we're back in person, we will continue doing Virtual Connects. It won't be as often as in the past, but you will see them pop up because let's face it, this has become a normal part of our lives here recently and for the foreseeable future. So a couple ground rules real quick. We will place everyone on mute when we start this discussion. That's usually the best way to keep it, no disruptions, no dogs barking, things like that. It lets our panelists actually do their things. The best way to view these webinars is by putting it in your viewer in speaker view. That allows you to just see the person who is speaking at that time instead of the Brady Bunch. What's always nice is that at the end, when we open it up for a little bit of conversation, go back into that Brady Bunch view and you can kind of see everyone and pick them out and just say hi and things like that. Feel free to use the chat box. You can chat with each other behind the scenes, send little private messages. I'm sure a lot of you haven't seen each other in a long time. So it might be nice to kind of catch up on that front. Also, we'll be monitoring that chat box for any kind of questions that we can pose back to the panel later on if we have time to get to that. Because as I said, there is a lot of information. So I'm going to be quiet. I'm going to pass it over to Bridgette Bello, our awesome publisher and CEO, to take this panel discussion away and get us rolling. Go ahead, B.
Thanks, Jason. Welcome, everyone. It's an exciting topic, and we're really excited to share it with you. I know we're all looking for creative ways to cash flow these days, to save money and keep our employees employed, and to not have to cut important things like marketing and advertising. Little plug there. We are Tampa Bay Business and Wealth Magazine. The majority of you know that. We're a CEO-centric publication, and these virtual connects have been our way of remaining relevant and continuing to offer valuable advice-driven content from local subject matter experts who can make an impact on your business right now. Sorry. We love seeing the social media that comes out of these, so feel free to screenshot the Hollywood Squares or Brady Bunch or whatever you refer to it as now, and connect with us on Facebook, Twitter, LinkedIn, and Instagram. We still like to use the same hashtag that we use for our live events, which is TBBW Connects. Little personal plug because I have the microphone. We were nominated for Best Startup, Best New Business. I was nominated for Best CEO, and Jose, my husband, and I were nominated for Best Couple. So vote for us on the Creative Loafing Best in the Bay, please. We would be honored to have that vote from you, and we hope that we win in at least one category, right? There are emails in the chat that will tell you how to submit your questions. We're hoping that we do get to some of those questions. Can't make any promises due to time constraints because we're always very respectful of ending the formal chat at 5:30 and then moving to the actual networking and cocktail hour. So without further ado, I would like to thank our panelists. We have some exciting ones today. Brooke Evans, the CEO and founder of CFO Alliance. Jay Clark, who is Managing Director for LCG Advisors. John Littler, National Director for TriNet. And Ron Wainwright, CPA, MST with Cherry Bekaert in Holland. So I'm going to go straight into the questions so that we can get the meat of this conversation going, starting with John. What areas do you have for, what areas do you have advice for cash flow management strategies during these unprecedented times?
Great. Well, thank you, Bridgette. So the first thing, just from TriNet, we're a national PEO organization, and one of our key goals in terms of working with clients is looking at cost optimization areas. And so as a part of that, one of the things we take a look at is take a look at the benefits at this time. What your benefit plans, obviously we're seeing a lot of stats out there that are indicating that next year during renewals, health insurance premiums can really start escalating. So in a PEO solution, you're in a group with a large, roughly about 313,000 worksite employees. So we're leveraging the benefit plans for you to control your costs. And I think when you think about the next 2 to 3 years, if there's a way to control your cost, there's the solution of a PEO, which will manage the benefits piece to it. You'll take a look at the 401k component and the workers' comp. And then when you take a look at the medical plan utilization and the overall total spend. So those are some areas of cost optimization I would suggest taking a look at. We're going through a lot of those particular plans with our clients as we speak. Well, also, I mentioned a little bit about the 401k piece to it. Lots of times when you think about 401k, there's an employer contribution to it. And frankly, during the times like this, and we've seen it with a lot of companies, feel free to scale that back a little bit. The employees are still potentially contributing to the 401k, but what you may want to do is now peel back a little bit, maybe for a 6-month or 12-month period, and look at ways that the 401k is still a benefit to the employees, but you can hold back the employer contribution until you feel like things are getting back to some form of normalcy. So those would be some of the things that I would share from a cost optimization, is just really pooling the benefits, taking a look at that, look at the 401k area, and also things like workers' compensation.
That's great information. Thank you so much for that, John. Jay, you guys prepare companies for liquidity events. Why don't you talk about the impact that this wonderful COVID-19 pandemic has had on alternative financing opportunities?
Thanks, Bridget. You make that sound fun, actually, in this time. So just so everybody knows, I'm with LCG Advisors, and we're a transaction advisory and investment banking firm here in Tampa. I run the investment banking side of the business, and we work with companies anywhere from 5 million to 150 million in revenue primarily, sometimes a little larger, but that's primarily our market, just to give you some background. So really from our standpoint, from a liquidity event or even capital, any type of capital raising or again, some type of sale, it's just added complexity to the diligence process for the most part, and uncertainty to the capital raising process. And we can talk a little bit more about that as we go, but what we're finding in the market today is if something is, if you're in process with a transaction right now, just expect it to take a significantly longer period of time to get it done because of indemnification issues that are related to COVID, and they're going to be looking at your disaster recovery plans and those types of things. It's just going to add complexity and time. So from our standpoint, just trying to figure out what the current new normal is, and the capital providers are all doing the same. That's really where we are today. So that's just a quick kind of thought on that, Bridget.
I'm sure we'll get more in depth on that in a little while. Yeah. Brooke, when we were doing our prep call, you referred repeatedly to a 13-week cash forecast. So why don't you talk about why you believe that that's so important?
Yeah, and so at risk of annoying all my friends who are on the call that hear me fanatically talk about this all the time already, I'll just give a little background on it. So I'm Brooke Evans, and CFO Alliance. We serve innovative founders on their growth journey with an outsourced CFO function. And really, we deliver our clients with a curated accounting and finance team that can help them as they start up, scale, and eventually sell their company, or even acquire and integrate other companies in their business. And so we're incredibly passionate at CFO Alliance around 13-week cash flow forecasting, because it's a systematic and precise way of organizing every type of cash transaction. And while that sounds really complex, let's face it, there's only two types of cash transactions. They're either coming in or going out. And so it's not that complex, but there are known items and forecasted items, and the timing may be known or unknown. And so taking all of those variables and putting the pieces of the puzzle together, it's not quite like Sudoku, even though I'm a numbers person, I don't like that, but it's more like Tetris, you know? So for anyone in the 80s who like Tetris, it's a bit more like that. And so again, it's extremely empowering because you can actually use the data to gain control and change the outcome. And essentially you can maximize the amount of cash you have at any given point in time. It doesn't mean it's a lot of cash, but you're gonna have as much as you possibly can. And so really smart business owners drive profitable companies, but exceptional business owners convert the profit into cash and have great strategic outcomes as a result. And you know, as much as it's valuable in times of uncertainty, it's actually as much or even more valuable in times of growth. So I think a great example of that, I was talking to an Inc. founder, I don't know, a couple of months ago, and he said in 2008, his banker required them to start using a 13-week cash flow forecast. They went through great periods of growth, as we all did in years past, and now they have like 600 weeks in their cash flow forecast. So
600 weeks is a little intimidating. All right, so again, when we were all preparing for this conversation and talking about the different innovative things that companies can do, I learned a lot. And for those of you who know me, you know that numbers are not my strong suit. There's a reason I'm on the creative and writing side. But I learned about R&D tax credits, and I want Ron to talk about those and talk about who they apply to and what they actually are. So Ron, are you available to do that?
Sure. So good to see everybody. My name is Ron Wainwright. I'm a partner with Cherry Bekaert, but I'm our national leader of credits and accounting methods. And so when you think about innovation, when you think about what's happening in our economy, there's over 165 provisions in the Internal Revenue Code, which can be a little overwhelming to people. It's about 72,000 pages, a very small print, which is actually larger than the Bible, but buried within that 72,000 pages are numerous federal and state subsidies. So the research and development credit was placed in the statute back in 1981, all about innovative and innovation in companies. So it's a federal and a state credit that can be monetized dollar for dollar against a tax liability. Sadly and unfortunately, even though it's been in the statute since 1981, the IRS would tell us that 65+% of companies across all vertical industries don't take advantage of it. That's 65+% of those that are eligible for the credit. Again, the credit's a dollar for dollar offset against tax liability. It's a subsidy. And so when you think about cash flow, when you think about infusion, when you think about innovation in a company, it's often overlooked and can literally put millions of dollars because you're always allowed to go backwards and capture those dollars. So in this COVID environment, everyone's looking to generate cash, appropriately so, as Brooke indicated. So those cash flow projections remain meaningful, but we find we can literally put, hundreds of thousands, if not millions of dollars in companies attributable to what is a broad term, but an innovation. But when you think about the tax law, innovation is a very broadly defined term. So, significant opportunity. Cherry Bekaert is a top 20 CPA firm, and I'm proud of the fact we're Southeast centric. So what does that mean? We're headquartered in Richmond, have 25 offices across the Southeast footprint. And we are the largest credit and accounting method team compared to any CPA firm. I founded the team about 6 years ago. So we have 25+ professionals that spend every day working in the credit and accounting method area. So stay tuned because we'll talk more about the opportunity as Bridgette gets through the panel today.
Thank you so much, Ron. So this conversation came about because of an amazing partnership between TriNet and Cherry Bekaert, and a conversation, quite frankly, with Megan, who's out there somewhere. I can't see her. But I got to hear a story about a trash truck company that got credit for R&D dollars and were able to recover a whole lot of money, that when we spoke to the actual owner of the company was ecstatic about what it meant to him personally. So can you explain, John, all the roles between a PEO, such as TriNet and an accounting firm such as Cherry Bekaert relate to research and development tax credits partnerships? Because that's not something I would have thought of prior to being privy to that story.
Yeah, sure, Bridget. You know, it was an interesting development because as the statute changed back in January 2017, as Ron indicated, we had a lot of our clients expressing to take advantage of the R&D tax credits through the payroll offset, which is one of the areas where it can accelerate getting that dollar for dollar credit quicker. And in doing so, you know, we had a chance to catch up with Ron and David Apple, managing partner in the Florida market. And I'll tell you, after the first two meetings, we just thought they would be terrific partners. They demonstrate such a high level of expertise, professionalism. And so what we did is we built a program as our clients came to us. And frankly, we began to learn from Ron that many of the businesses out there were just simply not aware that they were eligible for the credit. And as we educated ourselves, we did an outreach to our clients. So now basically what we have is a partnership where both our existing clients and prospective clients, when we identify an opportunity that they could explore R&D, Ron and his team graciously put together a free 20 to 30 minute call, a feasibility assessment as they call it, just to explore it a little bit deeper. And to the story that you shared, Bridget, I think there was another one. Megan has probably been our biggest champion in Florida. There was another company that I think Ron recently they won, and it was in excess of over $400,000 in R&D tax credits. And you know, these are some numbers that small companies could take advantage of it and take advantage on the payroll offset. The larger companies are seeing hundreds of thousands of dollars that frankly they didn't know, and it's newfound money for them. So, the nice thing about it is once we do it, Ron works very closely with our group. We're aware of it, and when it's a payroll offset for those companies that are startups and have less than $5 million in revenue, we wind up processing it. We're notified through them. We help complete the processing of the paperwork on the quarterly tax return. And then roughly within 90 to 120 days, once the government verifies that the credit's been validated, we actually show that credit as a line item on our client's invoice. So very transparent. They get to see the credit, and every penny of that credit's allocated back to the client. So that's where it's all developed. It's been really amazing over the last, just to kind of give you an idea, since 2017, we now just eclipsed $113 million in R&D tax credits that we've processed on behalf of our clients. So we're very proud, and our average client's saving roughly about $42,000 a year. Pretty amazing.
It is amazing, and we're going to talk about who some of those potential surprise industries are in a little while. But yeah, the trash truck person shared his personal income impact, and I was like, so what kind of R&D tax credits can we get as a magazine? I don't think Ron thought that we were eligible, but who knows? Brooke, you work with the people who are responsible for the finances in a company, and I think you have a unique perspective. Have you been a part of the R&D tax credit process with working with a PEO or an accounting firm such as TriNet and Cherry Bekaert?
Yeah, we sure have. And our niche market is innovative founders, and we serve a lot of companies in technology and technology-enabled services. We've had many clients go through the R&D tax credit process, and I'll tell you, having a great partnership with TriNet and Bekaert is huge. We've seen clients that have worked with both those groups, and it's been very smooth. And we've seen clients that have worked with other unnamed payroll providers, and it's not been smooth. So making sure that your payroll provider A, understands what they're doing, and B, is very proactive. It's not a simple process, and making sure that you've got partners who are also connected with each other, and then also having really good leadership on the company side. So either having an internal person on your internal accounting team or outsourcing it to someone that can be that great financial leader for you. It really takes those three parties to make sure it all comes together. And similarly, we've had clients that have received like $600,000 annually in R&D tax credits.
Which is amazing. And go back to that same story. He said, we're an S Corp, so that was straight into our pockets. And he was a very happy guy. We had Edmund Rakipi post a question that is kind of a great segue on this one, that if somebody wants to answer. He asked if the max R&D credit is still $250,000 annually. And based on the stories that I heard, I don't think it is. But can somebody speak to that specifically?
So Edmund is referring to what is referred to as the startup payroll monetization in the tax law, which John mentioned. So though the credit has been in the statute since 1981 and is permanent in the statute since 1981, it certainly has gone through numerous changes. Currently, if you are deemed to be a startup company being less than $5 million of gross receipts, there's a 2-year, 5-year testing period. You can monetize up to $250,000 annually against your employment taxes. That's at the federal level. What you'll find is 47 plus states have adopted, Florida actually being the most recent that adopted about 4 years ago, the R&D credit. But there is pending legislation that is on the Hill, not suggesting it'll make it through before November, but it is likely to make it through post-November in the election that would raise that $250,000 to $500,000 per year, and the gross receipts up to $10 million a year. Above that, being if you're defined to be a startup company, the credit is unlimited. So just to give you a sense of the magnitude of the credit opportunities and what taxpayers in the United States are claiming, and remember that less than 35% of those eligible taxpayers are claiming the credit. $10.5 billion of credit was claimed in 2014, the most recent year we have information at the federal level. It's estimated likely another $5 to $7 billion in that same 2014 year was claimed at the state level. So when you think about the subsidy, and I use that term intentionally statutorily for tax law purposes, the first thing that's happening in a company is you are deducting all of your costs attributable to your R&D efforts. Then you're allowed to use that same cost that you deducted that ultimately derives your taxable income. Therefore, you calculate tax liability. But you use that same dollar of cost to calculate a credit of up to 20% at the federal level, and states usually range from 5 to 10%. And that credit is a dollar for dollar offset against your tax liability. So I would say to Edmund, stay tuned. I'm fortunate to be part of the National R&D Credit Coalition. I sit on the board and the technical steering committee nationally. We have small little companies like Microsoft, et cetera, that are on the board with me. There is significant lobbying efforts to further enhance the credit, i.e. put cash back in the hands of innovation and innovative companies to continue to drive what we've found in our country as we are the, so to speak, innovators of the world.
So I'm going off script, which most people know I do that all the time, but is just so I understand what you said, Ron, are you saying 65% of the dollars that are available out there for R&D tax credits are not being claimed? 65% of taxpayers, actually what the Internal Revenue Service put out was what's often called an information release, came out in 2014. And for the IRS to tell you this, you kind of have to have your antenna up to begin with, right? Because they're the police force. But what they communicated was of all eligible taxpayers in the United States that could utilize and monetize the federal R&D credit, 65+% of those taxpayers were not claiming it, were not utilizing, were not monetizing it. And of those that were claiming it, that less than 35%, the majority of them understated the credit, understated the subsidy. So as we all know, we are a self-assessment country from the standpoint of tax liability. And so it's in the tax law. The sad part is 65+% of eligible taxpayers do not take advantage of it. And it's been in the statute since 1981. So I will tell you, Congress scratches their head every time they pass tax legislation as to what do we need to do different to incent or create the behavior of claiming this credit. But you are correct in your assessment, Bridgette. Yeah, that's wild, but I'll go back to the same example of, I'm sure if I was a trash truck guy, I wouldn't think I was eligible for R&D tax credits, right? So We'll talk about that later. We do have another question on the floor. It's another Brooke. She asked if somebody could comment on managed accounts payable systems. So I'm guessing that one should go to you, John. You're in my speaker view anyway, so that worked out great. Oh, he's like, oh no.
Maybe Ron. Ron, is that more towards your neck line there? Managed accounts?
Well, I guess I would clarify what is your definition of managed accounts, just so that I can answer the question correctly. I mean, that's a broad term of a managed accounts payable system. So
we'll let Brooke clarify in the chat, because
Okay.
that's where I saw that, and we'll move on to the next question, which ironically was for Ron anyways. Sorry for putting you on the spot, John. I thought you might be able to take that one. That's the downside of live TV when I go off script, right? So Ron, should everyone get off this call and call their accountant and say, am I eligible, or is this something that's specific to Cherry Bekaert, or like what should people be doing if they're like, oh my God, I might be eligible for these tax credits?
So selfishly, I would say call Cherry Bekaert. But the reality of the practice of tax law is that really only the top 25 firms in the country have what are referred to as credit and accounting method groups. As I mentioned, we are fortunate, having founded the team about 6 years ago, we're the largest credit and accounting method team in the Southeast. So that's compared to any of the final four firms, as we call them, PwC, EY, Deloitte, et cetera. What you'll find if you're not in the top 25, and really only the top 10 firms have what I would call real credit and accounting method teams. And that's not to be any way disrespectful to a very good, solid CPA firm. It's just that it is a complex area of the statute, been around a long time, as I've said. And so what you will find, and we do a tremendous amount of work for publicly held companies that have auditors that are in the top 10, and they refer their work to Cherry Bekaert and our credit and accounting method team. But you'll find that really only the top firms, probably the top 10, have competency, expertise, and subject matter. So we complete about 450, upwards of 500 R&D studies a year. So hopefully practice makes perfect. And so I would encourage you to reach out. As John correctly said, we will scope any and all opportunities complimentary. There's no cost. We come back and share what the magnitude of the opportunity is. And as you have correctly said, Bridgette, a trash company, really, when you think about the subsidy and the R&D credit, is really industry agnostic. It is applicable to all industries, even not-for-profits who don't pay tax. So every company, as we'll talk later, has R&D activity and are incurring costs attributable to it. It's always a question of what is the magnitude of the cost being incurred.
Well, so as to keep everyone hanging on, we're going to keep that question about what types of industries are eligible till closer to the end, just because I know that that's one of the things everyone probably wants to know. So we have been stuck on the R&D part for quite some time, and I don't want to ignore the other panelists and their expertise. Jay, you guys do a lot of different things, and I'm not going to try to say what it is, but my really small understanding of what you do is prepare companies for sale. You're also an investment banking firm and do all kinds of different things. So you're the one on the call that has the kind of experience with non-bank lenders and what kind of revenue metrics are required when evaluating a business for capital raise, right? And there's a lot of people on this call that are business owners that might all of a sudden surprisingly be considering that. So can you talk about that a bit?
Yeah, and it's kind of broad, right? So, we can talk about, when you're talking about non-bank lenders or capital sources, it could be something as simple as a commercial finance company, which is really just a different type of bank, just not subject to some of the rules that banks are. And, so for smaller, companies that need some asset-based lending, those types of things, those are good options. I don't think that's really what you're referring to, but we certainly have those options out there for smaller companies. But as you start to move into either private lending funds or, other types of financial providers out there that are looking to either provide, up and down the capital stack of senior debt or mezzanine debt or even equity. You are starting to talk about companies that, are probably a little bit larger. But even then, if you're talking about a SaaS related company with recurring revenue, a company like that with 5 or 7 million in revenue, could potentially attract significant amounts of capital from private groups. So it's hard to kind of base this off a number. So it's more related to what amounts of money they can invest. So when you can start to justify, let's say, a $2, $3, $4, $5 million investment in your company, based on that's more relevant than actual size. Because a SaaS company at 6 million, if they're worth 5 times, that's a $30 million valuation. They can certainly take on $5 million of minority equity, for example. So I think what's changed, though, is what I was talking about earlier. It's still uncertainty. I mean, we're in the market with, a couple of capital raises right now, and we have, let's say, in the last one, we had 170 groups that we approached, and I'd say 100 of them at least bowed out for various reasons almost immediately. But the reason basically was, we don't know what's going to happen with another wave. Combine that with the election, and we're just going to sit on the sidelines. Now, from a marketing purposes, they didn't tell me that because the last thing they want anybody to think is they're out of market. But they're out of market. That's just the way it is. So, there are other groups, though, that are willing to take on the risk of potentially investing into this market. And depending on industries, and we can talk about that now or later, there are certain industries that are in vogue right now. Some telemedicine or telehealth is obviously starting to be in vogue. Anything business to consumer that has an e-commerce platform not only is getting valuations that were consistent with before COVID, probably premium in some cases. Hard to believe, but it's true. So, there's a few industries that are on the are really in vogue. There are others, retail, for example. Furniture probably is not a great one. Commercial furniture. There's some other ones that are not doing well. So it's pretty broad, but there are options, and there's some other options. There's some government options too. I mean, everybody knows PPP loans, but I don't think many people understand or know what the Main Street lending programs out there now are from the Fed that are available to probably any business owner on the Zoom right now. You can borrow up to 6 times your 2019 EBITDA and have 5 years to pay it back. The first year no interest, the first 2 years no principal, then 15, and 70% at LIBOR plus 300, and LIBOR right now is under a half a point. So anybody can do that math, and those are available to virtually any company, depending if you qualify. And I know the vast majority of the companies out there have no idea it's even available to them. So there's other options out there.
I'm going to ask you to elaborate on that. How would somebody find out more information about that? Is it something we can put in the chat? Is it something we can send out to attendees afterwards?
Yeah, we can send out something afterwards. They can also, obviously they can Google the Main Street lending programs. There's actually 3 of them. One of them's for nonprofit. The other 2 are for, just ongoing businesses. And there's certain, you have to be, for example, under 15,000 employees and under 5 billion in revenue. That's probably everybody on this call. And there's other requirements that they have. They have, anytime the money has been lent to whoever it is, it has to be pari passu. It has to be senior to all your other banking. You have to, you can't pay off any of your other financing sources once this is outstanding. So there's some requirements that it has, but I'm talking, if you had a good year in 2019, that could be a significant amount of capital available. 6 times 2019 is the total leverage you can take on. So everybody can do that math pretty quickly and figure out this is a pretty significant amount of dollars. Unlike the PPP, though, there's no forgiveness. You will have to pay it back. So I guess that's the downside. But for that kind of inexpensive capital, it's really an interesting opportunity. And we're still trying to vet it as well. We haven't used it yet. From my standpoint, we're vetting it as well. So.
Are you seeing family offices being more aggressive during the pandemic, or any change there at all?
So I think that's exactly what I said before. It depends on the family office. The great thing about family offices, they're a fiduciary for themselves. So they can make decisions based upon what they feel, where they feel the market's going to go, without the risk of worrying that if they make a mistake, they potentially could put their fund at risk of moving forward. They could lose their investors and so on. I mean, they're investing on their own accord. So I'd say the family offices have an advantage that a lot of the funds do not at this point, is they can make decisions a little bit easier on what they want to do and how they want to take advantage of the markets. So we actually, are spending a lot of time getting to know more family offices, but it's a little bit of a mixed bag. Some of them are just saying, we're going to sit. Others are saying we're going to invest. And, everything is dependent upon valuation these days. And that's a tough one because of the COVID issue. So.
Sure. Everything's a tough one because of the COVID issue right now, right?
Yeah.
Nothing seems to be exempt from it.
Nope.
So I'm going to go back to Ron for the, I feel like our bait for the thing that we've been making everybody hold on to, or for, talk about some of the surprising companies that are eligible for that R&D tax credits, like the trash truck people, that people on this call might be like, that doesn't apply to me, there's no way.
So what I would comment is what is often misunderstood about, the Internal Revenue Code tax law, specifically this provision. As I mentioned, it's been out there since 1981. So it's got a long life and a long history. I think in the beginning, and I always like to go on record, it predated my practice in public accounting. But I would tell you, I think in the early years of, the R&D credit being in the statute, most people's perception was, it's about Dow Chemical, it's about a bunch of individuals running around in white lab coats with a bunch of Bunsen burners and, beakers. And that is the furthest from the truth today, as the law has evolved and been interpreted in a broader and broader sense. And so as we step back, and that's what I'd ask each of you to do, is step back and think about what the law says. And the law tells us, to the extent that a taxpayer is developing something that is new or improved, specific to the taxpayer, in what is referred to as business components by tax law. A business component is a product, a process, technology, a technique, a design, etc. So the definitional provisions of, quote, a business component are agnostic to any industry. Obviously, when you think about a product, you have a tendency to lean more towards, a manufacturing where they're manufacturing a widget, so to speak. A technology company is developing software. But as the law has been broadened, technology also includes internal use software that's been developed by a company, an algorithm. Every company is basically running off a software platform of some kind that they've either acquired, or they've acquired and enhanced it, or they have actually developed it based on their own technology individuals. So the world is full of technologists at this point in time. And every company only has to test itself around R&D towards itself. It doesn't matter if your competitor down the street has the product or the process or the software. So think about what we're experiencing right now. COVID-19, first of its kind. Every company is adapting its business in its entirety in regards to existing in a virtual world as we sit here today on a virtual call. Almost unheard of pre-January, February. Now we've become innovators or adopters of this new technology and virtually working from home, et cetera, with fancy backdrops, which I obviously had trouble loading. So the bottom line is that a trash processor would qualify because it has processes that they have developed. Processes also go throughout the entire organization. So when you think about the tax law, it also tells us administrative processes, your human resource process, your payroll process, Those are what are often referred to as support functions to a business. So the definitional provisions of what is new and innovative to a company, the test is only to itself. And again, it's been broadened over time, but that is the current test in the statute. And fortunately, based on a lot of court cases, revenue procedures that are, almost daily, the definitional provisions continue to be broadened. It is further going to be enhanced subject to the November elections. We have a credit of 20% in the United States. We compete against countries on a multinational level that Canada has a credit of 40%. So we are a little bit behind when you think about the subsidy that is supporting innovation and technology. But the reality is every company has what is referred to as a qualified research activity. Every company has qualified research expenses. It's simply a matter of documenting, substantiating those activities and costs to ultimately drive a credit. The one thing about the credit I would mention to you is if you can't fully utilize it in the current taxable year, we can carry it backwards. And most importantly, we can carry it forward 20 years. So Jay mentioned, we do a lot of private equity group nationally on the buy side and sell side. 65+% of sophisticated companies miss this opportunity. And I just give you an example, just to kind of give you the startup of 5 million of gross receipts or less. We just won a very, very large project on a publicly held company that had never taken advantage of it. And they're in the digital media space. And they had built technology platforms literally for the last 10 years. So whether it's a pharmaceutical company that's now pivoting towards COVID-19 therapeutics and vaccines, or simply a small business that is changing their internal processes to adapt to this world we live in, there's an R&D opportunity there. Question is, of course, the magnitude of the opportunity of the credit and how do you utilize and monetize it? How do you turn it into cash? Because cash is king. That help?
Yes, absolutely. I didn't realize I was on mute. I said in the creativity of making sure that it's something innovative, right? So let's switch gears for a minute. Brooke, I'm a fan of the 13-week cash forecast. Jason and I have operated that way for a very long time. And I think I know what the strategies and tactics for getting the most benefit out of it are, but I'd like to hear from your perspective what those are.
Awesome. Glad you're using it. And is it helpful for it? How long have you been using it and how helpful is it? Oh, you muted.
I don't want to age myself. I probably started using it when I was 12, but let's just call it 30 years.
Okay, you're way ahead of the curve. We need to have lunch and talk about that. We've already heard some great strategies from Ron around, identifying new cash streams that would be kind of one-off and, accretive to the business. What I want to talk about in terms of strategies is more around getting creative and adapting your day-to-day basic blocking and tackling. So I already mentioned there's two cash transactions. It's either coming in or it's going out. And so there's the order to pay cycle, and there's the order to cash cycle, and there's the procure to pay cycle. And so really what that means, if we just break it down, is how long does it take from the time you have a quote to actually get the cash in the door? And so the goal is to eliminate as many days as possible. And there's lots of ways to do that. It could be, process breakdowns. So I think what we see in times of growth is that companies get extremely top line growth focused to the detriment sometimes of being data driven or having great processes. And so looking at all of the process steps that occur between, the quote and receiving the cash and improving processes, especially there are so many automation tools out there. And then also in the procure to pay cycle, you might want to work with some really key vendors or even look at your supply chain. We had an example of one client who looked at their supply chain and actually reduced the number of vendors, still while avoiding having too much concentration, reduced the number of vendors because they were able to stretch payment terms and give a benefit to that vendor of having a long-term commitment. So it was a trade-off and a real win-win situation. So just looking across those two cycles to make sure, and we had another client actually that improved their processes so much. It actually went all the way back to they could not deliver their projects on time, and it was delaying being able to bill and then being able to collect. They were able to accelerate $4 million into a 90-day period of excess cash by going back to the source of the root of the problem. So automate, automate, automate. Also back to talking about relationship with your banker and just understanding all the potential programs that are out there that could benefit your business, spending time with your banker, understanding what opportunities exist for you.
So I was thinking after I said what I said, my process may not be your process, but it is a 13-week cash forecast. So maybe we should talk about how you can help me improve that. Jay, I'm going to go to you guys. I have been privy to a couple of deals that have closed over the last 6 months, friends of mine, and we had a question posted and I hadn't asked it yet because we had already planned to ask it, but talk about how the process differs from how it was 6 months ago, how COVID has impacted getting those deals done.
Yeah, no, we've been fortunate. We did close a transaction in June, and we closed another one in July, both of which were started prior to the COVID issues coming to market or coming to the United States. And interestingly enough, one of them signed just as we were getting into March and actually closed. That's the one that closed in June. The other one we signed before that, and we closed in July. And I think both of them had their challenges. The second one, though, we probably sat around for a month and a half just worrying about what was going to happen. So back to the uncertainty issue of what COVID means for a particular company, how they were able to get through those difficult months, what possibly might happen if there's another shutdown, those types of things, another surge. There was a lot of diligence around that, but we did a lot of diligence on areas that we don't usually spend a ton of time on. I said disaster recovery earlier, but that's anything that may result in a business shutdown, or if they have some type of outbreak at the firm. What exactly were they going to do, essentially, in layman's terms? Spent a lot of time on that, and this particular company didn't really have a disaster recovery plan. It's a typical smaller middle market company that just hadn't thought along those lines, and we spent a lot of time on that. We also got reps and warranty insurance, and the insurer spent a lot of time on that same issue. Indemnification obligations related to health issues on site, health issues that through work. So we've added in a whole new area of diligence, and it's going to continue to expand, I think, on every transaction, at least for the foreseeable future. So we're just telling clients, just expect more time to be spent in the box. Certain clients certain potential clients, we've basically said, sit it out unless you're so troubled that you have to get a troubled transaction done. Sit it out, try to take advantage of some government programs. Think about going back to market next year. But anything with recurring revenue or business to consumer, e-commerce, some healthcare, they're good markets right now. But even in good markets, it's all just going to essentially just add a month or two. Unfortunately, not something we want to hear what we do for a living, but it is what it is.
Yeah, no, I think we could do a whole nother virtual connect around that whole disaster preparedness and what that really looks like now. I mean, yeah. One of the privileges of my job is we talk to people across multiple industries, and one of the themes that keeps recurring now is the business interruption insurance, and that it doesn't include a pandemic, right? For the most part, because that never existed before. And those are things that you just don't think about until it's right in your face and you have no choice.
I agree. Yeah, so go have fun with the lawyers on all that. So it was both transactions. We probably spent a week on just those issues. Forget all the rest of the deal issues. Just a week on those issues for each deal. So
I bet. Well, we're getting close to the end of our time, and we have some audience questions, and I have 2 more questions. So, Ron, I'm going to ask you to be succinct on the answer to this one if you can. But what are the COVID-19 implications around innovation that are occurring right now and that are modifying business processes? And does that change whether organizations qualify for the R&D tax credits positively, negatively? I mean, just a quick answer on that.
So I think Jay outlined it. I mean, every company right now is going through, additional process changes, whether that's disaster recovery, which we would, call COVID-19. So as you think about a company changing all of their internal processes to function as well as get their product or services to market, those all fall under the business component of process changes. All the time and effort that's being spent to continue to be competitive and to continue to be successful. So COVID-19 is driving innovation throughout the country, throughout the company from top to bottom. And all of those changes will qualify as a qualified research activity. And you're spending money to do that. So that's the qualified research expense.
That was very succinct. Thank you. Good job. Mary has asked a question that said, last I checked, there are very few banks participating in the Main Street lending program. Why is that? And I am going to let you guys self-select on who should answer that.
So I'll take at least the first part of it, and we're still vetting that, but we're finding the same thing. I think a lot of banks are not trying to start relationships necessarily with leading with this product. But for companies that have good banking relationships that are on the approved list, and there's an approved list, you can go to the Boston Fed and look, that it's a real option and real opportunity to, expand your capital base a little bit. So I think there's still opportunities out there, and there are some institutions, you might not find them locally, or you might as well. You can find opportunities with certain banks that want to take over a full relationship that would certainly consider leading with this. The bank itself doesn't have a lot of risk because they have to hold 5% and the government actually buys in 95% of it. So they also don't necessarily have a lot of outstandings. So they can't pick up a lot of the other products. I'm not sure, if you think about it, why they would go that route. So it does make some sense that they want to pick up more than just the particular lending. But we haven't found a ton of it as well. So, but we're still looking, and there are still opportunities out there though.
Yeah, I would say from, I guess, Cherry Becker's perspective, we did a significant amount of work in the PPP program, and then, we stay on top of the Main Street program. I think the larger banks were slow to react. Obviously, a lot of them pulled out of being really, I'll pick on a couple that are, a Wells, as example said, or a Truist, we're not really going to be in that PPP program space. But what I think you're going to find is there's about $1.5 trillion left to spend in Tier 3. Certainly the Secretary is pushing a number of banks. So whether it's a First Citizens Bank that's now indicated out of Raleigh that they're going to participate, or a Fifth Third Bank that is now released that they're going to participate. I think the other thing the banks are uncomfortable with right now is the EBITDA calculation. The multiple on the EBITDA is a little bit higher than they can get comfortable with on a credit worthiness perspective. And as Jay said, they're exposed a little bit, so they got to worry about their balance sheet. But I think that there's a lot of push from the Treasury to push out that balance of $1.5 trillion, of which really only about $500 million is really what I would call Main Street. But I think you're going to see more and more of that, especially the longer, a non-therapeutic or a vaccine goes.
Well, and just because you're on the screen in my speaker view, I did get some clarification on the question earlier about managed accounts payable systems. And it was actually Ron that had asked that question. He said that he was asking about seeking discounts from vendors on the AP to help cash flow. So do you want to speak on that, Ron?
Well, the reason I asked for him to clarify was, of course, you can always factor your AR. So I wasn't real sure if that's what he was referring to on a managed accounts payable system. I think what we see in our practice with our clients, again, nationally, but more Southeast centric, is you're seeing, 60-day terms, 90-day terms, 180-day terms. People are stretching out their AP to manage, candidly, their balance sheet and cash flow. And so whether, and factoring companies are a little bit more concerned if you are factoring your accounts receivable and turning it into cash about, well, how long is it going to take me to collect that AR that you've now factored? And so that's what's happening if that, is specifically what you're talking about, managing your accounts payable, whether you're factoring, kind of your AR, if you will, to drive cash to pay off your accounts payable, or you're seeing terms stretched on the AR side and your accounts payable side. I mean, we're seeing major companies that have just announced that we used to pay in 30 days, we're now paying in 90 to 120 days because cash is king. And when I say major companies, I'm talking about, Target and some major retailers. I mean, Home Depot, because we're all doing home projects, is doing really well. But they announced the same thing, that we're going to manage our vendors because cash is king to us. So that's a tricky question depending on who you're dealing with.
Well, I think you did a great job answering it. And I think you guys all did an amazing job as panelists. And I want to be respectful of people's time because we tell them that the panel will stop at 5:30, even though the ones who have joined us before know that the whole event doesn't stop at 5:30. Most of the panelists have agreed to stay on and continue asking questions. And this is the time for you to get your glass of wine or whatever it is that you'd like to have for your networking opportunity. I see Ron has coffee. I have coffee. But thank you very much to our panelists, Brooke Evans, the CEO and founder of CFO Alliance, Jay Clark, Managing Director for LCG Advisors, John Littler, the National Director for TriNet, and Ron Wainwright, the CPA MST for Cherry Bekaert in Holland. For those of you on the call, we always encourage you to sign up for our daily e-newsletter. It is an opt-in product and something that we send out at least twice a week during these times. And please follow us on social media and post any fun nuggets or things that you learned or just pictures that you took, and tag TBBW Connects in those pictures. So we are going to end the formal part of this and transition to the networking part of it. And thank you all for being panelists and for sharing your very valuable insight into topics that are way above my head, but I learned a lot.